Step 2. Identifying factors associated with uncertainty. Once the strategic objectives have been broken down into more tactical, manageable pieces, risk managers need to use the strategy document, financial model, business plan, or the budgeting model to determine key assumptions made by the management. Most assumptions are associated with some form of uncertainty and hence require risk analysis. Risk analysis helps to put unrealistic management assumptions under the spotlight. Common criteria for selecting management assumptions for further risk analysis include: the assumption is associated with high uncertainty. The assumption impact is properly reflected in the financial model. For example, it makes no sense to assess foreign exchange risk if in the financial model all foreign currency costs are fixed in local currency and a change in currency insignificantly affects the calculation. The organization has reliable statistics or experts to determine the possible range of values and the possible distribution of values. There are reliable external sources of information to determine the possible range of values and the possible distribution of values. For example, a large investment company may have the following risky assumptions: the expected rate of return for different types of investment, an asset sale time frame, timing and the cost of external financing, rate of expected co-investment, exchange rates, and so on. Concurrently, risk managers should perform a classic risk assessment as per the process outlined in ISO 31000:2018 to determine whether all significant risks were captured in the management assumptions. The risk assessment should include a review of existing management and financial reports, industry research, auditors' reports, insurance and third-party inspections, as well as interviews with key decision makers. By the end of this step, risk managers should have a list of management assumptions. For every management assumption identified, risk managers should work with the process owners, internal auditors, and utilize internal and external information sources to determine the ranges of possible values and their likely distribution shape. Consider the following example of risk management implementation. Continued. Macroeconomic assumptions: foreign exchange, inflation, interest rates, rubles, interest rates, US dollars. Materials: DV30 materials, DV40 materials. Debt: current debt, new debt. Engine sales: new DV30 sales volume, new DV40 sales volume. DV30 repairs volume, DV40 repairs volume. DV30 price, DV40 price. Other expenses: current equipment and investments into new one, operating personnel, general and administrative costs. Based on the management assumptions above, VMZ will significantly increase revenue and profitability by 2018. Expected EBT in 2018 is 3,013 million rubles, which means the strategic objective will be achieved. We will review what will happen to management projections after the risk analysis is performed in the next section.